Enjoy your Saturday. Seriously. Go sit on the porch, hug your kids, watch whatever garbage Netflix is feeding you tonight. Because I am telling you right now, as someone who has not slept properly in 4 weeks, as someone whose eyes are bleeding from staring at order books in time zones most Americans don't even know exist, enjoy every single second of this quiet. Because tomorrow night, at exactly 6 o'clock Eastern Time, the financial world you think you understand is going to crack open like an egg on a hot skillet, and nobody on CNBC, nobody on Bloomberg, nobody in your brokerage app's cheerful little notification feed is going to warn you. They are not going to warn you because they don't understand what is about to happen, or worse, they understand it perfectly and they need you sitting still while the East executes the most devastating weekend ambush in the history of the precious metals market. I have been tracking this setup for 11 days. I have been watching the order flow, the COMEX vault reports, the Shanghai premium data, the IRGC press releases, the insurance premiums on tanker routes through Hormuz, the CME margin hike schedules, and I am telling you with every fiber of my being that what opens tomorrow night on the Asian futures exchanges is not a normal Sunday session. It is a financial assassination. It is a coordinated repricing event designed to destroy the Western short position in silver, while Wall Street's trading desks are dark, while the algos are sleeping, while the risk managers are at brunch. And by the time Monday morning's opening bell rings at the New York Stock Exchange, the damage will already be done. The price you see on your screen Monday morning will not be the price you could have bought silver at on Friday. It will be a price that has already gapped up, skipping entire dollar levels in a single tick, because the Eastern Hemisphere does not wait for permission from New York to reprice reality. They just do it. And they are about to do it tomorrow night. The suits want me to tell you this isn't financial advice. Of course it isn't. It's a survival guide for a burning theater. When the IRGC is literally on state television saying not 1 liter of oil will pass through the Strait of Hormuz, when Brent crude closed Friday at $112.57 a barrel, when Goldman Sachs is telling its clients that if Hormuz flows stay at 5% for 10 weeks daily, Brent prices will exceed the 2008 record, when the IEA director calls this the greatest global energy security challenge in history, what I am doing here is not financial advice. What I am doing here is reading you the crime scene report while the body is still warm. Do your own research if you still trust the people who stole your purchasing power. But if you want the raw data, the unfiltered timeline, the mechanical breakdown of what is about to happen at 6 p.m. Eastern tomorrow night, you are in the right place. Let's go. Let me set the scene for you, because this is important. Today is Saturday. The COMEX is closed. Wall Street locked its doors yesterday at 4 p.m. Eastern. The New York Mercantile Exchange, the Chicago Mercantile Exchange, the entire American futures infrastructure is offline, dark, nobody home. The servers are idle. The risk management systems are in sleep mode. The traders are scattered across the Hamptons, Connecticut, wherever these people go to pretend they are human beings on weekends. And here is the part that should make every single person watching this video sit up straight in their chair. The markets are closed for you. They are closed for the American retail investor. They are closed for the hedge funds on Park Avenue. But they are not closed for Beijing. They are not closed for Shanghai. They are not closed for Sydney. They are not closed for Singapore. They are not closed for Hong Kong. And those markets, those Eastern Hemisphere futures exchanges, they open tomorrow, Sunday, at 6 p.m. New York time. That is not a random fact. That is the most important fact in global finance right now. Because whoever controls the opening price on Sunday night controls the narrative for the entire week. And this week, for the first time in what I believe is a generational setup, the East has every single catalyst it needs to blow the doors off the silver market before a single American trader can lift a finger. I track these Asian market opens and geopolitical weekend traps so you are never caught sleeping when the global wealth transfer happens. I do this every single week. I cross-reference the COMEX vault data with the Shanghai Gold Exchange premiums, with the SHFE warehouse inventories, with the IRGC communiques, with the CME margin schedules. I do this so that you, the person watching this right now, are not blindsided on a Monday morning staring at a price you cannot afford. If this macroeconomic reality check helps you prepare for tomorrow night's shockwave, consider hitting that super thanks button below to support the channel. Because trust me, the algorithm does not want you seeing this. The engagement metrics on these videos get suppressed every single time I talk about physical delivery mechanics and Eastern market opens. Every single time. So that super thanks is not just support for me. It is a signal to the platform that this content matters, that people want to hear the truth about how global commodity markets actually function, not the sanitized, pasteurized, homogenized version they feed you on financial television. Now let me walk you through the mechanics. Let me walk you through exactly why tomorrow night is different from every other Sunday open. And I need you to pay very close attention here because this is where the data gets ugly. Let us start with what happened on Friday. Silver closed with the ask price at $70.64 an ounce on the spot market. Gold closed at approximately $4,460.75. The gold to silver ratio sits at roughly 63 to 1. Now, here is where it gets interesting. Silver hit an all-time high of $121.67 on January 29th of this year. That is barely 2 months ago. Since then, we have seen a brutal correction, a nearly 50% drawdown from the highs. The mainstream financial press, your CNBCs, your Bloombergs, they told you the silver rally was over. They told you it was a speculative blow-off. U.S. Treasury Secretary Scott Bessent literally went on camera and blamed Chinese traders for the entire rally. He called it a speculative blow-off. Think about that for a second. The Secretary of the Treasury of the United States of America went on national television and blamed China for silver going up. Not the 6 consecutive years of supply deficits. Not the fact that COMEX registered inventory has collapsed by over 80% from its 2021 peak. Not the fact that silver was added to the U.S. critical minerals list in late 2025. No. He blamed China. And do you know why he blamed China? Because China is winning. China is taking delivery. China is draining the vaults. And the American financial establishment cannot admit that the paper pricing mechanism they have used to suppress precious metals for decades is breaking down in real time. Let me give you the COMEX numbers, because these numbers are the murder weapon in this crime scene. COMEX registered silver, the metal that is actually available for delivery against futures contracts, has fallen below 90 million ounces. As of late February, the number was 88.191 million ounces. That is a 32% drop in 4 months. 4 months. The total COMEX silver inventory, registered plus eligible combined, has crashed from 532 million ounces in October to 366 million ounces. That is a 31% decline, and here is the number that should make your blood run cold. The coverage ratio, which measures what percentage of outstanding paper claims could actually be satisfied with registered inventory, stands at 13.5%. Below 15% is what analysts call stress territory. We are in stress territory. We are deep in stress territory. The paper leverage ratio is 7.4 to 1. That means for every single ounce of silver that is actually sitting in a COMEX vault ready for delivery, there are 7.4 ounces of paper claims. 7.4 pieces of paper that say someone owns an ounce of silver that does not exist in deliverable form. Let me do the math for you live because I want you to see this with your own eyes. 88 million ounces of registered silver. At $70 an ounce, that is $6,160 million. $6.16 billion. That is the entire deliverable silver inventory backing the COMEX futures market. $6 billion. Do you know what $6 billion is? That is a rounding error on Apple's balance sheet. That is less than what Amazon spends on shipping in a quarter. That is the GDP of a small Caribbean island nation. And that $6 billion of physical metal is supposed to underpin a futures market where open interest regularly represents 400 to 500 million ounces of notional exposure. The March delivery cycle alone saw 10,526 contracts standing for delivery. Each contract is 5,000 ounces. That is 52.63 million ounces of delivery demand against 86 million ounces of registered inventory. More than 60% of the entire registered stockpile was demanded in a single delivery month, and that came right on the heels of February, which saw 5,036 contracts delivered, the highest February delivery volume in modern COMEX history. This is not normal. This is not a blip. This is a systematic, methodical, relentless drain of physical metal from Western vaults. And where is that metal going? Follow the breadcrumbs. Follow them east. The Shanghai Gold Exchange has been trading silver at a premium of $8 to $13 per ounce over COMEX. $8 to $13. That is not a rounding error. That is not a statistical anomaly. That is a screaming, flashing, red alert signal that physical silver is worth dramatically more in Asia than the paper price in New York says it should be. The Shanghai Futures Exchange warehouse inventory has collapsed from 559 tons in November 2025 to 318.5 tons in February 2026. That is a 43% decline in 3 months. Combined, the COMEX and Shanghai drawdown represents approximately 161 million ounces pulled from exchange inventories over 6 years. And here is the kicker. The remaining metal that has been consumed, roughly 659 million ounces, went into irreversible industrial applications: solar panels, electronics, electric vehicle batteries, defense systems, AI infrastructure. That silver is gone. It is not coming back. It cannot be economically recovered. It has been permanently consumed by the very technologies that the modern world depends on. So when someone on financial television tells you there is plenty of silver, ask them one question. Where? Where is it? Because it is not in the COMEX vaults, it is not in the Shanghai warehouses, and it is not coming back from the solar panels bolted to rooftops across China. Let me know in the comments below. Are you holding physical silver in your own hands today? Or are you praying that the paper market survives the Asian Open tomorrow night? Because I want to hear from you. I want to know what the premiums are at your local dealer right now. I want to know if your coin shop even has inventory. Tell me. Because the data I am tracking from the institutional side says the physical market is tighter than anything I have seen in my career, and I want to cross-reference that with what is happening on the ground, at the retail level, in your city, at your dealer, right now. Drop it in the comments. Now let me explain the mechanism of how tomorrow night's gap up works. Because this is not speculation, this is not a guess. This is math combined with time zone arbitrage combined with the most volatile geopolitical backdrop since the 1973 oil embargo. A gap up occurs when a market opens at a price significantly higher than its previous close, skipping all the prices in between. It literally gaps. There is no trading at the intermediate levels. The price jumps from point A to point C, and point B never exists. This happens because during the period when a market is closed, new information enters the system, new catalysts, new risks, new data. And when the market reopens, it must immediately reprice to reflect that new reality. The bigger the information gap, the bigger the price gap. And right now, the information gap between Friday's close and Sunday's open is a chasm the size of the Grand Canyon. Here is why. The Strait of Hormuz crisis. Let me walk you through this because this is not just an oil story. This is a silver story. This is a gold story. This is a dollar story. This is the story of the end of the unipolar financial world order. On March 2nd, the Islamic Revolutionary Guard Corps officially confirmed the Strait of Hormuz was closed. The single most important maritime choke point on planet Earth, through which 20% of the world's daily oil supply and massive volumes of liquefied natural gas flow, was shut down by Iran in retaliation for U.S. and Israeli strikes. Since then, tanker traffic has dropped to essentially zero. The IEA called it the greatest global energy security challenge in history. Greater than the 1973 embargo, greater than the 1979 Iranian Revolution, greater than the 2008 financial crisis. The IEA director, Fatih Birol, said it was worse than the two oil shocks of the 70s and the impact of the Russia-Ukraine war on gas combined. Brent crude surged past $100 a barrel on March 8th for the first time in 4 years. It hit $126 at its peak. WTI crude, the American benchmark, closed Friday at $99.64 after briefly touching $100. Oil is up 55% since the war started on February 28th. The IRGC went on state media and said, and I quote this precisely, "Expect oil at $200 per barrel, 200. They said the price of oil depends on regional security and called the United States the main source of insecurity in the region. Goldman Sachs raised its Brent forecast to 110 for March and April. They said if Hormuz flows remain at 5% of normal for 10 weeks, daily Brent prices will likely exceed the 2008 record. The 2008 record, when oil hit $147 a barrel right before the entire global financial system nearly collapsed. Now, why does this matter for silver? Why does a $200 oil shock translate directly into a silver gap up? Let me connect the dots because CNBC will not do this for you. First, inflation. $200 oil is not just expensive gasoline. It is a cascading inflationary event that poisons every single supply chain on Earth. Diesel prices above $5 mean higher transportation costs for every product in every store. Fertilizer prices spike because 45% of global sulfur production comes from the Gulf states that are now blockaded. The Fertilizer Institute says nitrogen fertilizer prices could roughly double from 2024 levels. Phosphate prices could increase by 50%. That means food prices explode. And when food and energy prices explode simultaneously, what happens to the purchasing power of the US dollar? It gets annihilated. And what happens when the dollar gets annihilated? People run to hard assets. Gold, silver, the metals that have been money for 5,000 years while every single fiat currency ever created has gone to zero. Every single one. Second, safe haven flows. Gold is at $4,493 an ounce. It hit an all-time high of $5,595 on January 29th. The PBOC, the People's Bank of China, has been buying gold for 15 consecutive months. Central bank demand is structural, not speculative. And silver, which historically trades at a ratio of 40 to 60 relative to gold, is currently at 63 to 1. That ratio compression alone implies significant upside for silver just to revert to historical norms. If gold stays at 4,500 and the ratio compresses to 50 to 1, silver goes to $90. If gold rallies back toward 5,000 on the geopolitical chaos and the ratio hits 45 to 1, silver goes to 111. These are not fantasy numbers. These are simple division. This is third-grade math applied 5,000-year-old monetary relationships. Third. And this is the one that nobody is talking about, the physical delivery mechanism. Silver is not just a precious metal. It is an industrial metal. Nearly 60% of annual silver demand comes from industrial applications: solar panels, AI data centers, defense electronics, medical devices, 5G infrastructure, electric vehicle batteries. Solid-state batteries, which are the next generation of energy storage technology, require silver. And every single one of those supply chains runs through Asia, through China, through the very markets that open tomorrow night at 6 p.m. Eastern. When those markets open, and the quant funds and the sovereign wealth managers and the industrial procurement desks see that the Strait of Hormuz is still closed, that Trump's 10-day pause on strikes expires April 6th with no deal in sight, that the IRGC is still firing drones at tankers in the Gulf of Oman, that 2 Chinese container ships were turned back from the Strait on Friday, that nearly 500 million barrels of total liquids have been lost, they are going to do exactly what the data tells them to do. They are going to buy physical silver. They are going to buy it aggressively, in size, at the ask, because they know that the supply is not coming back, that the industrial demand is not discretionary, and that the paper price on COMEX at $70 does not reflect the physical reality on the ground in Shanghai, where premiums are $8 to $13 above New York. And because Wall Street is dark, because the American market makers are not at their terminals, because the COMEX is closed and the CME servers are in weekend maintenance mode, there will be no American sellers to absorb the volume. The sell side of the order book will be thin, paper thin, a joke. And when a wall of Eastern buy orders hits a vacuum of Western liquidity, the price does not move up incrementally. It does not tick up a penny at a time. It gaps, it jumps, it teleports from $70 to $73, $75, $78 in a heartbeat, in a single candle, in 1 second. That is a gap up. That is the Sunday night ambush. And by the time the New York trader opens his Bloomberg terminal Monday morning with his overpriced coffee in one hand and his complacency in the other, the price on his screen will be a number he has never seen on a Monday open. And his short position, his naked short, his rehypothecated paper claim on silver that does not exist will already be underwater. The margin call will already be waiting in his inbox. And the scramble, the panic buying to cover, will create a feedback loop that pushes the price even higher. This is not the first time the East has used the Sunday open to ambush Western shorts. Let me give you the historical precedents because the rule of 3 demands it. 1971, August 15th, a Sunday. Richard Nixon went on national television and closed the gold window. He severed the last link between the US dollar and physical gold. He did it on a Sunday night because he knew the markets were closed, and by the time they opened on Monday, the new reality would already be priced in. The decision had been made at Camp David over the weekend. The public found out Sunday evening. Monday morning, the world woke up to a completely different monetary system. That was the original Sunday night ambush. The dollar lost over 97% of its purchasing power against gold from that moment forward. Gold went from $35 an ounce to over $2,000 in the decades that followed, and the American public was told it was for their own good. 2008, September 14th, a Sunday. Lehman Brothers declared bankruptcy, the largest bankruptcy filing in American history, $639 billion in assets, announced on a Sunday. By Monday morning, the financial system was in freefall. The Dow dropped over 500 points. Credit markets froze. The repo market seized up. And for those who understood what was happening, the Sunday night was the tell. The Sunday night was when the real repricing began. Gold rallied from around $700 to over $1,900 in the years that followed. Silver went from under $9 to almost $50. The people who were positioned before the Sunday night announcement were the ones who survived. Everyone else was a casualty. 2020, March 15th, a Sunday. The Federal Reserve, in an emergency meeting, cut interest rates to zero and announced $700 billion in quantitative easing. They did it on a Sunday night before the Monday open because the COVID crash had already destroyed the markets the previous week and they needed to front-run the Monday panic. Futures markets opened Sunday evening and immediately reflected the new reality. Gold surged. Silver, after an initial liquidity-driven crash, went from $12 to $30 in the months that followed. A 150% move. The Sunday night intervention was the starting gun, and now, March 2026, the Strait of Hormuz is closed. Oil is at $100. The IRGC is threatening $200. COMEX registered silver has collapsed by 80% from 2021 highs. The coverage ratio is at 13.5%, deep in stress territory. Shanghai premiums are $8 to $13 above COMEX. Warehouse inventories on both exchanges are in freefall, and tomorrow night, Sunday night, at 6 p.m. Eastern, the Asian futures markets open into a weekend full of unpriced geopolitical chaos while Wall Street sleeps. Smash the like button right now to break the 2026 shadow ban. I am not kidding. These videos get throttled. The algorithm buries content about physical delivery mechanics and COMEX inventory data because it does not fit the narrative. Every like, every share, every comment is a signal to the platform that this information matters, that people want the truth, that the financial media's monopoly on the narrative is breaking down, just like the COMEX's monopoly on silver pricing is breaking down. Smash it. Now let me talk about the algos, the repo market algos, because this is where the institutional warfare gets truly ugly, and this is what nobody else will explain to you. When the Asian markets open on Sunday night, the first thing that happens is the electronic order matching engines boot up. The CME Globex system goes live. The Shanghai Futures Exchange opens. The Sydney Futures Market opens. And within milliseconds, the algorithms begin scanning. They scan the news wires, they scan the geopolitical feeds, they scan the oil price, they scan the order book depth, and they calculate a fair value for silver based on the weekend's events. This is called a gamma flip. Gamma, in options trading, measures how quickly the delta of an option changes. When gamma flips from negative to positive, it means the market makers who were previously selling into rallies suddenly need to buy into rallies to maintain their hedges. It creates a self-reinforcing feedback loop. The more the price goes up, the more the algos need to buy, which pushes the price up further, which forces more buying. It is a liquidity cascade, a V-shock, an avalanche that feeds on itself. And here's the critical detail, the repo market, the overnight repurchase agreement market, where banks lend each other money using treasury bonds as collateral. This market is the plumbing of the entire global financial system. When oil goes to $100, the collateral value of energy-related assets changes. The margin requirements on commodity positions change. The banks that are short silver on COMEX need to post more collateral. And if they cannot post more collateral because their balance sheets are already stressed by the oil shock, they are forced to cover, to buy back their shorts, in a market with no liquidity, on a Sunday night, when the only sellers are the Eastern smart money that is not selling, that is buying. This is rehypothecation in reverse. Rehypothecation is the practice of using the same collateral to back multiple positions, 1 ounce of silver backing 7.4 paper claims. When the music stops, when the margin call hits, when the repo market tightens, that rehypothecation unwinds violently. The same ounce of silver that was supposedly backing 7 different trades suddenly has 7 different claimants trying to get their hands on it simultaneously. That is a force majeure event. That is the moment the COMEX declares that silver is what I call unobtainium, technically available on paper, physically unavailable in reality. The CME can raise margins. They have already done it. They did it in January when silver was at 121. They did it in 1980 when the Hunt brothers were at 49. They did it in 2011 when silver touched 48.70. Margin hikes are the establishment's fire extinguisher, but you cannot put out a structural fire with a fire extinguisher. You can slow it down, you can buy time, but the building is still burning. And the fuel for this fire, the geopolitical fuel, the supply-demand fuel, the monetary debasement fuel, that fuel is not running out. It is accelerating. Let me talk about the geopolitical angle, because this is not just a silver trade. This is about the architecture of the global monetary system in 2026, and it is crumbling in real time. The United States national debt is now $39 trillion. The 10-year Treasury yield jumped to 4.46% on March 27th, its highest level since July 2025. The 30-year mortgage rate climbed to 6.38%. The dollar is supposed to be the world's reserve currency, the safe haven, the flight to quality asset. But when your own Treasury Secretary is blaming China for silver going up, instead of addressing the 6 consecutive years of supply deficits, when your government is spending $200 billion on a war in the Middle East while running annual deficits north of $2 trillion, when the Federal Reserve is holding rates at 350 to 375 with zero probability of cuts and a 35% chance of a hike, the dollar is not a safe haven. It is a burning building, and the rest of the world knows it. The BRICS nations, Brazil, Russia, India, China, South Africa, and their expanding roster of partners, are actively building alternative payment systems. The mBridge project, which is a cross-border central bank digital currency platform built on distributed ledger technology, is designed to bypass SWIFT entirely. China's central bank has been buying gold for 15 consecutive months. Russia has been accumulating gold reserves for years. India's silver ETF inflows are surging. The East is not just talking about de-dollarization. They are executing it. They are building the infrastructure. And physical gold and silver are the foundation of that new system. Basel III and now Basel IV regulations have reclassified physical gold as a Tier 1 asset for banks. That means central banks can hold physical gold as the highest quality capital on their balance sheets. Silver is not there yet, but the trajectory is clear. When silver was added to the U.S. critical minerals list in late 2025, it signaled that the U.S. government itself recognizes silver's strategic importance. You cannot build solar panels without silver. You cannot build AI data center infrastructure without silver. You cannot build advanced military electronics without silver. You cannot build the next generation of solid-state batteries without silver. The metal that the paper market says is worth $70 is indispensable to every major technology trend of the 21st century, and the supply is running out. Here is the forecast for Monday morning. Here is what I believe happens when the New York bell finally rings. The retail public will look at their screens and see a number they do not recognize. Silver will not be at $70. It will be at whatever price the Asian session determined it should be based on the weekend's geopolitical developments, the Hormuz status, the oil price, and the physical delivery demand. If the strait remains closed, if the IRGC maintains its blockade, if Trump's 10-day pause expires April 6th with no resolution, the gap up could be massive. $3, $5, possibly more. And at that point, the algos on the COMEX will wake up and see that they are underwater. The short positions that were profitable at 70 will be hemorrhaging at 75. The margin calls will go out, the forced covering will begin. And because the registered inventory is at 88 million ounces, because the coverage ratio is at 13.5%, because there is nowhere to source physical metal in size, the covering will push the price even higher. It is a feedback loop, a gamma squeeze, a liquidity cascade that feeds on the very mechanism that was supposed to suppress the price. The window to acquire physical silver at Friday's paper prices is closing. It may already be closed by the time you watch this. The premiums at your local dealer are going to reflect the new reality before the COMEX spot price does, because your dealer lives in the physical world, not the paper world. Your dealer knows what silver costs to source, to ship, to insure, to hold in inventory, and those costs are going up every day, every week. The physical market and the paper market are diverging. They have been diverging all year. The Shanghai premium of $8 to $13 is the proof. The COMEX vault drain is the proof. The record delivery volumes are the proof. And tomorrow night's gap up will be the exclamation point. I will be monitoring the geopolitical newswire all weekend and tracking the exact second the Asian futures markets go live on Sunday night. I will be watching the Globex Open, the Shanghai Open, the Sydney Open. I will be cross-referencing the oil price with the silver order book in real time. Make sure you are subscribed to the channel with the bell notification turned on so you get my emergency alert the moment the gap up begins. Because if you are not watching at 6 p.m. Eastern tomorrow, if you are not positioned before that open, you will wake up Monday morning to a price that has already moved without you. And in this market, in this environment, being late is the same as being wrong. Make sure you're following my secondary channel in the featured section too, because we are covering the oil side of this crisis over there in real time. We're hitting them from both sides. The silver story and the oil story are the same story. They are two fronts in the same war. The war on your purchasing power, the war on sound money, the war on physical reality by a paper financial system that is running out of time. Let me leave you with this. The fiat illusion takes the weekend off. The COMEX closes. The banks go dark. The algorithms go to sleep. Wall Street shuts down and pretends that the world pauses when America pauses. But the world does not pause. Geopolitics does not pause. The Strait of Hormuz does not pause. The IRGC does not pause. The physical drain of silver from Western vaults to Eastern industrial consumers does not pause. The only thing that pauses is your ability to react. And that pause, that gap between Friday's close and Sunday's open, is the weapon. It is the weapon that the East has been sharpening for months. And tomorrow night at 6 p.m. Eastern, they are going to use it. If you want to see exactly how my portfolio is positioned to profit from this Sunday night ambush, if you want to see the specific allocation between physical, metal, mining equities, and options strategies that I am using to capture this gap up, click the join button and become an insider member right now. The Insider tier gets my real-time positioning updates, my emergency alert system for weekend geopolitical events, and my weekly COMEX vault analysis that tracks the registered inventory drawdown ounce by ounce. This is not a sales pitch, this is a survival pitch. The financial system, as you have known it for the last 55 years, since Nixon closed the gold window on that Sunday night in August 1971, is entering its terminal phase. The paper price of silver at $70 is a lie, the physical price is already higher in Shanghai, and tomorrow night, the physical price is going to drag the paper price kicking and screaming into reality. Be positioned, be prepared, and for the love of everything you hold dear, hold it in your own hands. Physical metal in your possession is the only asset in the world that carries zero counterparty risk. No exchange can default on it, no brokerage can freeze it, no government can bail it in. It is yours. It is real. And after tomorrow night, it is going to be worth a lot more than it was on Friday. This is John CC. This is the Currency Archive. The Sunday Gap Up is coming 6 p.m. Eastern tomorrow night. Be ready. I'll see you on the other side.